Welcome to the AGM presentation for the Polar Capital Global Financials Trust. My name's Tom Dorner and I'm joined by George Barrow. We're co-managers of the trust. What you see on slide one is an overview of the team, five members of the team focused on the trust who collectively have over 100 years of experience, which we see as quite valuable in what can at times be a complicated sector. We're showing you here the long-term growth in net asset value per share for the trust since the tender in 2020 at 19%. That is ahead of the benchmark of MSCI equity financials and also ahead of the peer group and wider in UK equities, which is a performance we're quite pleased with. Since inception, the compound annual growth rate of the trust has been just over 10.5%, again, ahead of the financials benchmark, which I think in the long term is a very attractive absolute level of return for shareholders. This slide, we're showing you the discrete annual performance of the trust. If we take a step back and take a look at what we mean by global financials, there's two key points. The first is that the sector is one of the largest in the market. In fact, the second largest sector within global equities, just behind technology, just sometimes forgotten by investors. And on the right-hand side of the slide, you can see a breakdown of what exactly sits within global financials. So a lot of the discussion is around banks, and they are very important, but they make up less than half of the benchmark. There are other very important sectors within financials too, such as insurance or diversified financials, which include a variety of different things like asset managers or exchanges. And indeed, the payment sector sits within financials. So it's one of the largest sectors in the market, and it's also a lot more diversified than people sometimes appreciate. This slide, what we do is show you how some of these subsectors fit in terms of cyclical defensive attributes and whether they are more value or growth oriented. And we've also highlighted some of the sectors that we currently like in the portfolio. So, for example, European banks has been a sector we've liked for a long period of time. And the same for trading platforms. Both of them have more cyclical characteristics. In the last year or so, one of the notable changes is that our preference within the insurance sector has changed meaningfully away from P&C insurance and in favor of life insurance. So hopefully you take away from this that there's a variety of different subsectors, and we'll change our preference for those subsectors depending on where we see the best risk reward at any point in time. On this slide, you can see a breakdown of some single stocks that we like within the various subsectors. So there'll be some brands here that you're familiar with, but also a number of names like Alpha Bank or Global Life or Flatex that are perhaps slightly off the beaten track. So by doing fundamental stock-specific work, we can identify both names you'll be familiar with within financials, but also some things that are slightly more esoteric where the risk reward we think is favorable, and put those together into a balanced and attractive portfolio for investors. So why would you want to consider financials at the moment? What we're showing you on this slide is a breakdown of global equities by market capitalization. And the thing that really stands out is that the North American IT sector is so dominant within global markets. Now, we're not saying that that's a good or a bad thing, but what we are saying is it's probably a greater exposure in people's portfolio than they realize. And now is probably a good time to think about diversifying into sector like financials that has some very favorable fundamental trends. And over the long term, the relationship between value and growth in this chart shown in the US has been quite cyclical. And what's notable here is how unusual the period of outperformance of growth relative to value has been since the financial crisis. And that's starting to revert back to normal, particularly outside of the US. Value has been starting to outperform for some time, and that makes sense and is consistent with an environment where interest rates are slightly higher. So we think that's a meaningful tailwind for value-oriented sectors such as financials. And you just shouldn't just take our word for it. What you see here is how financials have performed relative to global equities and value indices, that they're roughly on par over a 1-year view, but over 3 and 5 years, financials have been very meaningfully outperformed both wider equity markets and value indices. So if you are trying to diversify, we think the case for financials is strong, and it's been working nicely in recent years. So there's a lot of debate around the risk of AI disruption across the market. And what we've done here is giving you our assessment of AI disruption risk by subsector within the financial sector. And what we're showing you based on the size of the bubbles is the amount of the trust's NAV that's invested in the sectors. And the key message to take away here is we think the bulk of our assets are invested in parts of financials where the AI disruption risk is relatively modest. And we actually think there might be some opportunities in oversold other subsectors within financials. This focuses on the potential upside from AI to financials, looking based on data from PwC, looking specifically at an example of banks. We're looking here at the cost income ratio of a bank potentially improving from 65% to 50%, which is a huge potential efficiency improvement. And the biggest driver of that, based on PwC's analysis, is the cost efficiency potential within the middle office. So through improving some of the operational inefficiencies, system inefficiencies that exist through AI, the potential to make the businesses significantly more efficient is very significant. So in aggregate, our view is that the net impact of AI on the sector is much more positive than the AI disruption risk and some of the share price movements might make you think.
So on this slide, we highlight the key themes that the trust is invested in and the proportion of the trust on the right-hand side, a mixture of cyclical themes such as the valuation opportunity in European banks and some of the regulatory reform that we're seeing for US lenders, alongside some more structural themes such as growth in emerging market financials and some of the long-term support for growth in life insurance within Asia. And we're looking to balance that out with some beneficiaries of the pickup in volatility in terms of trading platforms. In terms of platforms, names such as IG Group, IBKR and Plus 500. On the right-hand side, we've highlighted the relative performance during different market drawdowns, with the green section showing significant outperformance during periods of market weakness and elevated volatility. So in terms of portfolio construction, they have been helpful. On the left-hand side, we've highlighted the different age that different generations start investing. So we are seeing a structural shift in terms of engagement with investing, and we think that should support long-term growth. In terms of European banks, which remains an overweight in the trust, this chart highlights the relative price to earnings against the broader markets. We continue to see an attractive valuation support for European banks, which are trading at around a 30% discount to the broader market, despite a significant improvement in terms of profitability and capital return. European banks continue to see positive earnings revisions, supported by a pickup in loan growth, but also a steeper yield curve. And we expect that positive EPS revision to continue to support the relative performance. Turning to life insurers, we have exposure through names like AIA and Prudential. On this slide, we highlight the long-term trends within profit per share and dividends. We continue to see an attractive long-term story linked to aspects like urbanization, growing wealth within China. AIA also benefits from increased licenses being granted, which are opening up the country in which it has under a 2% penetration. So we see an attractive long-term growth outlook for names like AIA. So moving to regulatory change, which for US lenders continues to be a tailwind. We've seen a change in terms of heads of regulatory agencies feed through into an easing in terms of regulation for US lenders. This is also feeding through into a pickup in terms of consolidation. So on this slide, we highlight the time taking for a transaction to close. So before these changes, it was taking up to between 18 to 20 months. And we're now seeing the most recent transactions being approved within 3 to 5 months. So a definite change within the regulatory backdrop. The trust held Webster, which is acquired by Santander. We think that's a sign of things to come with a pickup in consolidation supported by this regulatory change. So moving to emerging markets, which represents around 16% of the trust, we're invested across multiple themes within emerging Asia, Latin America, and Eastern Europe. Just to highlight a couple, we are overweight in Korea, where we continue to see support from the value-up corporate governance reforms. We're also invested in Latin America through names like New, what we highlight on the right-hand side, continues to take market share. It now has over 120 million clients and is now expanding rapidly within Mexico. So overall, we are seeing an improvement in the underlying conditions for the sector, feeding through into a pickup in terms of profitability. On this slide, we highlight the improvement in return on equity for financials overall. In terms of valuations, the sector continues to offer significant value in what is an extended market, trading at now under 11 times earnings. We should note that payments came into the sector, which added around 100 basis points to that multiple. So all else equal, it is trading close to its 20-year median, despite a significant improvement in terms of the underlying conditions. Despite the outperformance by the financial sector, we've barely seen much of a change in terms of the value versus growth, which we think highlights the opportunity for the sector going forward. So in summary, we see a compelling opportunity for the sector. We feel we have the internal resources to be able to capitalize on what is an improving outlook for the space, and we've made several enhancements to the structure of the trust. This slide includes a summary of current positioning of the trust. If you have any questions for the managers or the board, please email cosec@polarcapital.co.uk with the subject PCFT-AGM.